changes in equity will have all the components. Now, changes in equity will have your share capital, share premium, retained earnings, your equity instruments designated at fair value through OCI, your debt instruments designated at fair value through OCI will all be forming part of equity. You have to do the reconciliation between what belongs to parent and what belongs to NCI. Reconciliation of the beginning and the end. Whatever you could not present in these financial statements, you will be presenting in the notes to accounts. Notes to accounts are schedules. You give additional information relevant to users of all the items you have shown as part of balance sheet, income statement, statement of changes in equity, or cash flow statement. In the notes, you give a statement of compliance with IFRS. In India, will be issuing a statement of explicit and unreserved statement of compliance with IndAS. The companies who are following IFRS, they issue an explicit and unreserved statement of compliance with IFRS. In India, we cannot say that we are complying with IFRS. We are actually complying with IndAS, though they are more or less same. A summary of significant accounting policies used. The measurement basis like FIFO weighted average. What is the measurement basis used by us? The other accounting policies followed by us, and supporting information to be presented in the notes to accounts relating to your balance sheet, income statement, cash flow, each line item. If it requires clarity, you disclose it. Disclose the details around it in the notes to accounts. Other disclosures like contingent liabilities or unrecognized contractual commitments, non-financial disclosures, entities, financial risk management, objectives and policies as per IFRS 7 are also disclosed as part of your annual financial statements published. We follow these features like while we are preparing financial statements on the basis of IFRS or IndAS, that we are preparing financial statements on going concern basis, and if there is any uncertainty or doubt on going concern basis, we may have to prepare financial statements on breakup model on net realizable value basis. So we believe that the company is going to run for a foreseeable period is the reason we prepare financial statements on going concern status. But if there is any doubt or uncertainty on the going concern status of the entity, we cannot present financial statements on going concern basis. We need to change the model to breakup model on net realizable value basis. Materiality and aggregation. Materiality is what? The omission or misstatement, if something is omitted or misstated, can influence the economic decisions taken on the basis of financial statements. Something which gets omitted or misstated, if it can influence the economic decisions, it is material item. It may be material as an individual item, it may be material in aggregate. Like there is an item of salary worth 5,000 bucks, but it has, this error is committed 1 lakh times. So in aggregate, it becomes material. Offsetting is not allowed under IFRS. Only in certain circumstances offsetting is allowed, like if you are dealing with the same authority, your income taxes can be offset. If you're dealing with the same authority, your deferred tax assets and deferred tax liabilities can be presented as a single item in the balance sheet. You'll not be presenting deferred tax assets separately or deferred tax liabilities separately. You can offset them. You can offset your pension liabilities, the fair value of planned assets and fair value of planned liabilities. You can present one net item, net pension benefit asset or net pension benefit liability as a one line item. Offsetting is allowed in case of employee benefits, post-employment benefits. You're allowed offsetting if it doesn't hamper the decisions of the users of financial statements. In all other areas, it is not allowed. So I'll show you where it is allowed. Frequency of reporting, that we should publish financial statements at least annually once in a year, and what quarterly or 6 monthly depends on jurisdiction to jurisdiction. But ISB says that at least once in 6 months you should publish your financial statements. You should at least inform the users what is happening after you published your annual report. And if you're doing it, you should continually do it. You should consistently report the financial statements on the same dates. Comparative information is mandatory. As I said, if you're presenting financial statements on 31st March 17, we need to give comparative of 31st March 16 as well. Consistency of presentation means you use the same headings and subtotals which you have been using year on year, so that there is no confusion in the minds of the users of financial statements. They can understand financial statements easily. Accrual basis of accounting. We record transactions and events when they occur. We do not record transactions and events on the basis of cash inflow or cash outflow, because if we do so, if our business is on credit basis, that if I purchase something on credit, and if I'm doing cash basis accounting, I'll not be able to record any purchases. Purchases is zeros because they are purchased on credit. Sales, If I sell all my goods on credit, sales amount 0, gross profit 0. I have engaged myself into activity of purchasing goods on credit, selling goods on credit, but have not been successful in recording any profit or reporting the events and transactions which occurred because cash flow accounting doesn't allow me to do so, is the reason I use accrual basis of accounting to report all the events and transactions which occurred during a particular period. So the income statement belongs to a particular period. If my financial year is beginning on 1st April 2018 and ending on 31st March 2019, all the events and transactions which have occurred in this period, I'll be reporting in this period income statement. Fair presentation and compliance with IFRS. ISB allows overriding the standards if you believe that the manner in which you are presenting is going to give you fairer presentation. You can deviate from the standard, but you need to give evidence. You need to disclose the fact why you deviated from the standard, what made you to believe that it gives fairer presentation, and you need to give a lot of disclosures around it to satisfy the auditor that your deviation of a standard is providing fairer presentation. Fairer presentation compliance with IFRS. Financial statements must present fairly the financial position, income statement, cash flow. It requires faithful presentation, the effects of transactions, events, condition, as per the requirements of the definition of asset, liability, equity, income, and expense. We record according to the standards and additional disclosures if you believe that it will lead to fairer presentation. Entity will make an explicit analysis of statement of compliance with IFRS in each statement published. When you are allowed to override, as I said, in extremely rare circumstances, if compliance would be misleading, if you follow the standard, and departure will help in giving fairer presentation, you can do so if management has concluded that financial statement present fairly, even by deviating from the standard, your financial statements give a true and fair view. And this becomes the basis for developing of a standard. In future, this may become the basis for developing a standard. You have complied in all material respects. You have deviated from the standard, which standard you deviated, why you deviated, the nature of departure, the financial impact of the departure. You need to disclose all these in the notes to accounts. Going concern, as I said, if there is any doubt, if there is any uncertainty, you cannot continue to recognize your financial statements on going concern basis. You need to do it on breakup model. You believe that your financial statements or your company is going to run for a foreseeable period. Offsetting, as I said, is not allowed only in certain circumstances like releases of provisions against expenses incurred. You can set off like bad debts, provision of doubtful debts if it can be settled or netted off. Gains or losses on disposal of non-current assets and reported after deducting the carrying value. You can show them as part of your net book values if you are charging depreciation directly onto the historical cost. And selling proceeds, you can net off if you are allowed to do so. So offsetting, except when it reflects the substance of transaction, it is allowed. Otherwise, offsetting is not allowed or not permitted unless permitted by other IFRS. Like in case of employee benefits, like in case of taxes, you're allowed. And there also it mentions only if it is with the same authority, only if it is allowed. Items not considered offsetting are accumulated depreciation, impairment provisions, accumulated amortization, provision for inventory obsolescence, provision for bad debts are not considered offsetting. They'll follow normal accounting, but this deduction or this provision is not considered offsetting of items. Frequency, as I said, we need to present at least annually. And if we are not presenting it annually, and if we are using a different period, we need to state the reason why we deviated from that period, why we presented 15-month report or why we presented 9-month report. Accrual basis accounting, record transactions and events when they occur, not when cash is received or paid. As I said, materiality is important. Materiality in aggregate or materiality individually. The omission or misstatement could influence the economic decisions taken on the basis of financial statements. This has gone further. There is an amendment in the definition of materiality effective from 1st January 2020. Old definition says that omission or misstatement of item are material if they could individually or collectively together could influence the economic decisions taken on the basis of financial statements. New definition says that information is material if omitting, misstating, or obscuring, you're trying to hide, or you're not presenting it fairly. Obscuring is the word added. Misstating is the word added. Earlier there was omission or misstatement, but you're purposely doing it or omitting it, misstating it, or obscuring it could reasonably be expected to influence the decisions that the primary users of general purpose financial statements make on the basis of those financial statements which provide financial information about a specific reporting entity. So there is a slight change in definition of material, even obscuring also result in deviating from materiality concept. Consistently, you need to follow the same headings and subtotals. You need to present it from one period to the next. And change is allowed only if the change IFRS allows so. It is allowed in one case wherein we are consolidating. When we are presenting consolidated financial statements, if the period is 3 months or less, there is a deviation allowed that you can extrapolate or interpolate the financial statements of 9 months and you can present consolidated financial statements if you do not have the results for a complete 12-month period or of the same period. You can use those small period financial statements if the period is 3 months or less. You're allowed to consolidate. That we'll discuss in detail when I'm discussing consolidated financial statements. Comparative information is mandatory, is the reason we need to provide the current year. Along with it, comparative is mandatory. If I look at the key differences between IFRS and IndAS or the previous gap, the presentation of financial statements, as I said, option of 2 statements in IFRS, but only single statement in IndAS. Classification of expenses based on nature of expense or function of expense, we'll only use nature-wise classification. Frequency of reporting, it permits the periodicity 52 weeks for preparation of financial statements, but in India, the mandatory date of financial reporting is 31st March each year. So this is not permitted in India. The loan part I've already discussed with you that if I've got rollover or refinancing, I can continue to recognize that liability as part of my non-current liability under IndAS, but under IFRS I'll not be allowed to do so. I'll have to classify it under the head current liabilities. Different terminologies can be used, like statement of financial position can be shown as balance sheet. Fair presentation can be, we can use the word true and fair view. Authorization can be approval of the financial statements for issue. So this is all for the framework and presentation of financial statements under IFRS.